welcome to The Explainer. Today, we are digging into a really fascinating research paper, one that pretty much takes a sledgehammer to the retirement advice we've been hearing for decades. So get ready, because what we're about to go through might just change how you see your 401k forever. So let's just dive right in with the big question this research forces us to ask. Is the standard issue 401k advice we've all been given, the stuff we all follow, is it actually built on a myth? You see, for years and years, pretty much all retirement advice, from books to the actual federal regulations for 401k plans, has been built on two main ideas. These are like the golden rules of investing for the long haul. And here they are. Rule 1, you gotta diversify between stocks and bonds. Rule 2, as you get closer to retirement, you dial back the risky stocks and pile into safer bonds. Right? This is the entire logic behind those target date funds that are the default option for millions of us. Okay. But what if that advice, that universal wisdom, is just wrong? Well, a really powerful study from 3 finance professors decided to put these core ideas to the test. And honestly, what they found is kind of a big deal. I mean, it doesn't get much more blunt than this. This is literally in the opening of their paper. They're not just poking holes in the theory. They are directly challenging the entire foundation of modern retirement planning. So you might be wondering, what's their big idea? Well, after crunching a mind-boggling amount of data, we're talking over 2,600 years of market history from 39 different countries, this is what they say is the best portfolio. It's 100% stocks, split between about a third domestic and 2/3 international. And what's the most glaring thing missing from that pie chart? Bonds. According to their research, the optimal amount you should have in so-called safe assets like bonds and bills is 0. A flat 0, not just when you're young, but for your entire life. Now, that just flies in the face of everything we're told. So this leads to the obvious question, right? Why no bonds at all? Why would you diversify with more stocks from other countries instead of bonds? Well, the answer they found has everything to do with how these different assets actually behave over the really long time frames we're talking about for retirement. And this is where things get really wild. Our whole idea of risk gets turned completely upside down. The paper shows that over a 30-year horizon, bonds, the asset we think of as safe, actually get riskier. The returns are low, they don't protect you from inflation. Meanwhile, international stocks not only give you way higher returns, but their volatility, their riskiness actually goes down over that same long period. And the hard data here really tells the tale. Just look at the real returns after you account for inflation. Less than 1% for bonds versus over 7% for international stocks. And check out that variance ratio column. That's just a fancy way of showing how risk changes over 30 years. For bonds, that number is way above 1, which means their risk more than doubles. For stocks, it's below 1, meaning their risk actually drops. It's a total reversal of what we'd expect. Okay, so let's put this to the test. How does this radical, all-equity strategy actually perform in a head-to-head battle with the industry standard, the good old target date fund, or TDF? Well, here's what it costs you to stick with the old way. The researchers found that for a target date fund investor to end up with the same amount of money as someone saving 10% in the all-equity fund, they'd have to save 16.1% of their income. That is a staggering 61% more money you'd have to pull from your paycheck just to break even. And here is how that plays out on average. The all-equity strategy gets you to over $1 million by retirement. That's a full 39% more than the standard TDF. I mean, that is a life-changing amount of money we're talking about. But here, this is the real kicker. What about not running out of money? What about capital preservation? The TDF, the fund that's designed for safety, had almost a 20% chance of leaving the investor flat broke in retirement, and the supposedly risky all-stock portfolio, just a 7% chance. It is nearly 3 times better at the most important job of all, not going broke. The difference in what gets left behind for family or causes you care about, it's even more dramatic. The all-equity strategy, on average, left behind almost $3 million. That's more than 4 times what the TDF investor left. So to put it all together, the all-equity strategy didn't just win, it dominated the standard retirement fund on both of the things that matter most, growing your money for the future and making sure that money lasts once you get there. So this all begs a pretty big question, right? How could the conventional models, the ones everyone uses, get it so wrong? What are they missing? Well, the researchers point to a few huge flaws. For one, these old models often just look at US market history, which has been an incredible but unusual success story. They also tend to assume that market returns are totally random, which ignores real-world things like momentum and market slumps. But the biggest miss is, they just don't account for how bonds get riskier over time, and they seriously underestimate the incredible diversification you get from owning stocks all over the world. So, after all that exhaustive analysis, the paper basically gives us a new, simpler rule, and according to their data, it's a much more effective one. Diversify your stocks globally, not with bonds, and just stay fully invested in those stocks for your whole life. And that leaves us with one last, really provocative thought to chew on. When you're planning for something as long-term as retirement, is it possible that the strategy that's designed to feel safe is actually the one exposing you to the biggest risk of all, the risk of outliving your money? This research certainly suggests the answer is a resounding yes.